Good morning. This is Scott Murray. Welcome to the Daily Economic Market Shout for Wednesday, November 2nd, 2022. The Fed spoke and the markets were disappointed. The Fed raised the Fed funds rate 75 basis points. That was in line with expectations, although they hinted that they will soon start not hiking as much, meaning that we will start to see a tapering of the hiking cycle. Typically, when that starts, it happens pretty quickly as the Fed realizes it's probably gone a little bit too far. In this situation, I think what they're communicating to the market is what we kind of suspected all the way along, is that the Fed really is not able at this point to really stop the inflation element that's out there. This inflation element is really exogenous. It's coming from oil and has the span of the pandemic. Supply issues have worked through the economy. We got really good news over the last 48 hours on this issue, with both prices paid and a pickup of supply deliveries. So we think we've now reached the end of the corner of the supply issues and sort of these elements in the inflationary element. So it was probably not a good message to sort of deliver, maybe more of a victory lap, maybe more of we expect we're there, instead of this unsurety that I think is playing the marketplace. And that really drives on the fact that little is understood about inflation, and the fact here that we had housing inflation be particularly high. That was actually a feedback loop from the higher interest rates that we saw, higher mortgage rates, then transported into the measurement of housing inflation. Housing inflation does not impact everyone. It's not like the gas at the pump where we see it universally. And that's why energy was such an important element, because yes, it is not part of core inflation, how it seeps into our everyday living, where housing really doesn't, unless you're buying a house or have an adjustable mortgage. So I think that the market is going to have to shake off over the next couple of weeks this disappointment, but I think we'll get better readings that will kind of tell us as we move forward. Inflation is hard. We've seen an outsized short-term rate movement. It has hit smaller businesses, which we saw with the ADP number yesterday. We'll probably see a little bit more of tomorrow with the employment area. Medium firms did well in terms of employment, and larger firms, I believe, are taking some opportunity here to downside, readjust their workforce as they move ahead. So we think labor is strong, and we think the inflation element has moved lower or less concerned. Still, we're seeing higher interest rates, and the sharpness of the increase has been particularly troublesome to financial institutions which are looking for liquidity. Even the U.S. Treasury saying that they're still trying to retire lower rate coupon notes and issue higher coupon notes so that the market has a little more liquidity there. So looking ahead, a disappointment we have to work through from the messaging from the Fed, and the inflation area is actually a little bit more constructive than we saw before. This is Scott Murray for the Daily Economic Market Shout. Thank you for joining me here today.